welcome to the Mutual Fund Guide. It's all about your funds and your returns. I'm Vandita Shivle. Joining me on the show today is Jitendra Solanki, founder of JS Financial Advisors. Welcome to the show, Jitendra, and thank you so much for joining us today.
Good afternoon.
Yeah. So viewers and Jitendra, before we begin with our first query, let's take a look at the winners and losers of today. Every day, we will bring you the top funds in the equity category. While it is important to stay invested for a reasonable period of time to make money, it is also very important to track fund performances. There are a large number of funds for you to choose from, and you can have the the funds which we just mentioned, the top funds in the equity category. They're on your screen. These are the thematic funds, and in the market cap category. So yes, those are the funds for you. All right. So let's move on. We have our first email. That's from Mr. Pushpendra Mahajan. He's from Pune and he's emailed us. His age is 31 years. He has a 1-year-old son and he wishes to accumulate 1.5 to 2 crore rupees for his education. He is investing through SIP of 2000 rupees in each ICICI Prudential Blue Chip, Kotak Standard Multicap, Mirae Asset Emerging Blue Chip, Reliance Small Cap, and L&T Emerging Businesses Fund. He's asking, is his fund selection and allocation accurate, and does his portfolio need any further changes? And he's looking for your suggestions, Mr. Jitendra.
Okay, so first look at his contribution, what is required. Now, if you have to accumulate 1.5 to 2 crore corpus in say possibly a 16 years time, because his son is 1 year old and age of 16, 17 is when he's going to start college.
Right.
So, in a 16 years time frame, if you are able to earn a 12% ROI, then you require approximate 30 to 40,000 per month of investment. And the investment he is doing currently is lesser than that. So first of all, he has to see whether he can allocate that much surplus or not. Now, if he cannot allocate, then he will have to review the target goal of his son's education. So that was the first aspect. Second, coming to his portfolio, if we look at his portfolio, it's fairly diversified. He has a large cap fund in his portfolio. He's got a multi cap fund and he's a small cap fund. It's a fairly diversified, but I think one important factor is that when you make a diversified portfolio with a mixture of categories, and if you keep a bit amount of higher exposure in funds like small cap, so you will see more volatility in your portfolio. So in a downside market, you may see large cap funds are performing better, but your small cap funds are fairly down.
Right.
So you need to be prepared for that volatility. If you do not have that risk appetite, then probably you are good with more large cap and multi cap funds in your portfolio. So funds are fine. Just remember that the amount of exposure you are having in all these categories.
All right, so balance your portfolio from the return and risk perspective. That's the advice for you. Let's move on to our next caller, who's Vinod. He's on the line from Chennai. Hello and very good afternoon, Mr. Vinod. What's your question?
Yeah, hi, good afternoon. Actually, I want to invest in mutual funds for the both beneficial for the wealth creation and to tax beneficial also. So, which type of funds can I go to?
Yes, Mr. Vinod, and if there are a couple of questions that were in our mind when you're giving your query. So, number one, your age is 23, right?
Yes.
All right. So let's see what he has to say. And you do not have any goals in place? Like, do you have any goals in your mind?
Yes, ma'am.
Okay. So is it like short-term goal, long-term goal?
Long-term goal.
Long-term goal. All right. So let's see what Mr. Jitendra has to say.
Okay, so for tax saving purposes, you have equity linked saving schemes in mutual funds. Now, when you invest in an ELSS scheme, so you get tax benefit of 1.5 lakh under 80C. So first of all, he has to see that what amount of tax saving does he require, because if you are a salaried individual, you might be having EPF or you might be a PPF going. There are other options also. If you have already done with that option, that what is the money you should be investing in ELSS. So look at that contribution. The second is when you come to ELSS scheme, so they are equity linked saving scheme, that is they invest into equity markets and they have got a 3-year lock-in. So that means for the next 3 years you won't be able to switch or redeem those investments. After 3 years they are open-ended scheme and you can continue with those investments.
Right.
which are the schemes to opt for. Within ELSS also you have a fairly diversified schemes available. So some schemes like Aditya Birla Tax Relief 96, or you have Axis Long Term Equity. So these are the schemes where a bit amount of mid cap or small cap exposure is there. But if you look at scheme like Franklin India Tax Shield, then you will find that it is more oriented towards large cap. So I think if you are investing possibly more than ₹1,00,000, you can have these two schemes in your portfolio, and you can continue them for long term because they are fairly good schemes.
Right. I just wanted to add one point here. Could you give our viewers some perspective on LTCG part of it? Because, you know, when they are investing in ELSS schemes, this LTCG, long-term tax gains, you know, they play a very important role, and they really confuse ELSS investors. So what do you have to say on that?
Okay, yes, it's going to be a bit confusing because till last year there was no LTCG in ELSS.
Right.
So whatever you earn after 3 years, you withdraw, it's completely tax free.
Right.
But in the last budget, the government introduced an LTCG tax of 10% from equity mutual funds. So that means after 3 years, it is going to be a long term horizon because it's more than 1 year. You are going to pay 10% on LTCG tax on your equity gains. But yes, there has been exemption given that up till 1 lakh of your capital gains is going to be tax exempted. So that means once your capital gains goes beyond 1 lakh, then you will have to pay a LTCG tax of 10% whenever you withdraw your money.
Right, and that's without any indexation benefit.
Yes, that's true.
Right. So Mr. Vinod, does that answer your question?
Yes, I got the answer.
All right. So
Yes,
that
thanks.
was, yeah, sure, Mr. Vinod. Many congratulations. You are a very young investor, and all the very best with your investment journey. Let's move on to our next email. That's from Mr. Gundu Rao, who's from Mysore, Karnataka. He has emailed us. He's 33 years old and is investing through SIP of 3,000 rupees in each Motilal Oswal Multicap 35, Principal Multicap Growth Fund, Franklin India Smaller Companies Fund, L&T Emerging Businesses, and ABSL Pure Value Fund. His time horizon is pretty good, 17 years. He wants to accumulate a corpus of 2 crore rupees for his retirement. He will gradually increase his SIP amount to 5,000 rupees. He's asking, can he continue investing in the funds which we just mentioned, or does he need some consolidation or switching? What do you suggest?
There are two aspects towards it. One is the age you are, and when you are nearing a retirement. So his age is 33 years.
Right.
So he has got a good fairly time for his retirement needs.
Absolutely.
So let's look at the contribution first. So to accumulate 2 crores in 17 years, you need an investment of at least 32,000 per month. When you are able to earn a 12% return on investment, anything below than that, probably your contribution should be higher.
Right.
So first you have to look at that contribution. If not, then you should revisit your goal. Coming to a mutual fund schemes, again it's a fairly diversified mutual fund schemes. You have multi-cap scheme and you have got a small cap scheme in the portfolio. So again, I would say when you are having a small cap, so just see that you are comfortable with the risk. It is going to you will see in the volatility in your portfolio.
Right.
I would still advise that having a one small cap fund would be good, and probably adding a large cap fund, index fund like UTI Nifty index fund is going to do good for an efficient portfolio.
All right. So you feel that it's well diversified fund, and he could add the fund that you just mentioned, and that could add. You want to add on to something?
Yeah, portfolio is fairly diversified, but as I said, keep a small cap exposure lower. He has 2 funds from the small cap category in going to invest 6,000 per month. Right. He's going to increase the investment up to 5,000.
Yes,
so
yes.
probably from one small cap, you should add a large cap index fund. So with a 70% into large cap and multi cap, and possibly the rest
Right.
into mid and small cap, makes a good investment portfolio.
Yeah. So maybe adding a large cap to instead of a smaller small cap fund would be the right way for you. All the very best with your investment journey. Let's move on to our next caller, who's on the line from Bengaluru, Mr. Velayudan. That's a tough name. Anyways, very good afternoon, sir. What's your question?
Good afternoon. Yeah. Okay, I am 65 years old, and hello.
Yes, we are there. We are able to hear you.
Yeah, I am 65 years old, and I have up to 75 lakhs to invest in mutual funds.
Yes.
I would like to invest it for a period of 3 years and then hope to do an SWP and get around 75,000 to 80,000 per month for the next 15 years or so. Is it possible? And what I should do, what sort of investments I should make,
Okay.
and whether this money should be put lump sum or as SPP.
All right. So basically, he's 65 years old and he wants to generate regular income through SWP route. So what are you suggesting him?
See, first of all, when you are generating a regular income, so first is you have to see your horizon, how much longer you want that corpus to sustain. Now, even at the age of 65, 70, if I take a life expectancy of 85, 90, you still have 15, 20 years to sustain that corpus if you are completely dependent on that monthly income. Coming to the corpus and the withdrawal rate, when you invest in an SWP kind of a scheme, you look at less volatile investment, you look at investment which can produce a steady income. So from the mutual fund categories, liquid fund, ultra short term funds are an ideal option, but having an 80,000 per month withdrawal from 75 lakh corpus is a 13% rate of withdrawal.
Right.
I think that is way too high, because your withdrawal rate should match the return you are earning on your investment. So liquid ultra short term fund, even on the higher side, when we take a 7% return on their investment, then probably your withdrawal rate should be somewhere around 5 to 6%. That is going to be an ideal portfolio or the ideal SWP strategy. 13% I personally feel is a way too high, because that it will deplete your corpus very shortly. You won't be able to sustain it much longer, because that's a huge difference between what you are withdrawing and what return you will earn on your investment. So I think probably my advice would be to sit with an advisor and chart out this SWP strategy, and whether only SWP is going to be an option, or you still have any other option where you can do mix of SWP and any other fixed income instrument, and can look at maximize the withdrawal.
Yes. So Mr. Vilayudan, do you have a follow-up question? Do you understand?
Yeah. No, I think I had mentioned that I can wait for 3 years before I start the SWP.
Okay. So
I think I presume he thought I'm starting now the SWP. I'll wait for 3 years and then start the SWP.
Yes. So what he's basically trying to tell you is that the kind of SWP that you want with your investments, that the interest, that would mean that you are expecting a return of 13%, right?
Okay.
So let us get back to Jitendra and we'll let him clarify.
Yeah, see, when you are saying an SWP strategy, right? So SWP, when you want to have from mutual fund, you want to earn a return on that investment, and you probably look at that I have this monthly income generated from the return. Okay. Now on a 75 lakh, 13% yearly return will give you 80,000 per month. I think depending completely on the return is going to be too high, because 12% we look at long term investment from equities, right, which is investment from at least for 10 years. So I think withdrawal rate you will have to revisit. You will have to see that comfortably, if you want an SWP strategy, I think 6% withdrawal rate you have to look at from your investment, which will ensure that the corpus is sustained much longer. Otherwise you will end up withdrawing from your capital of 75 lakh, that in any way when you have put into a saving account you can still have the same strategy. But I think mainly coming to SWP means I can earn a decent return and I can sustain my corpus much longer. So you will have to bring down the withdrawal rate.
Rate. And assuming that he has brought down the withdrawal rate, so what are the kind of funds that he could look for?
For an SWP, either liquid and ultra short term fund are an ideal option, because you cannot look at volatile investment, because you are withdrawing every month. So even if you wait for 3 years, 3 years waiting is going to do good, because you will have then only long term capital gain tax from debt funds, because after 3 years it is LTCG in debt fund. So that is going to do good for your tax efficient withdrawal. But I think to have a monthly withdrawal from the return.
Right. So does that give you some clarity, Mr. Vilayudan?
Yeah, that did tell me something. Yeah.
And
Thank you so much.
Yeah, and you can always sit with your financial advisor, work on your plans. You can give us a call back again. We're always there to help you on that. All right.
Okay. Thank you.
Yes.
Thank you so much.
Yes. So thank you so much, Mr. Jitendra, for joining us today.
Thank
we
you.
are completely out of time now, and viewers, that's all for this edition of the Mutual Fund Guide. That's how you save, invest, and prosper with the right guidance right here on Business Television India. Thanks for watching us today. Stay tuned. We have lots more lined up for you.